In just the past 3 days, what are the charts telling us could be next? Are there areas that look oversold? Katie Stockton is founder and managing partner at Fairlead Strategies. Katie, great to have you with us. Have we seen damage done to the S&P 500, you think?
Well, there has been a distinct loss of momentum, but it's really still only short-term in nature, and no breakdowns have developed among the major indices. Even the Russell 2000 index is holding up okay despite having underperformed throughout the pullback. For the S&P 500, we're watching support right around 45, 46, and that's based on its most recent breakout point, so essentially a former peak on the chart. And there's also that 50-day moving average rising to meet that level. So it still does have some support nearby.
I mean, intraday, Katie, we're well off of the session lows right now. And I'm wondering if you take a look at that intraday action and think, you know what, this proves my theory, or your theory in this case, that the S&P 500 does have support. And this is just a minor setback within a longer-term uptrend channel.
There is support, and also we have the first short-term oversold reading since October 4th for the S&P 500, and that's meaningful. It will be more meaningful when we do see some kind of stabilization. I think it's too early to suggest that we have it already, but to the extent that we do see a strong close relative to the day's high-low range, that's always an incremental positive. And of course, the market internal measures, things like market breadth or participation, market sentiment as measured by things like the VIX, those are all getting pretty oversold on their own. So that suggests that perhaps that sentiment has shifted enough to get us a short-term low ahead of what is typically a positive seasonal time of the year.
I want to talk about volatility. We did see it spike today. It's up 17% at this point, though, again, off of the highs that we've seen in the session. Are you seeing that also in an uptrend going forward? I mean, I would imagine that at some point, no, because you're seeing the S&P 500 has support and is going higher.
Well, we have been in this low volatility cycle really for several months based on the VIX, which we use as a transactional gauge of market sentiment. We indeed have seen a VIX spike over the last couple of days, and that, of course, is associated with a pullback in the S&P 500. They're negatively correlated. What we don't want to see from the VIX is a breakout above the top of its range, which is roughly 29 on the chart. It's also a resistance level per our work, and that would then suggest that we're getting into a higher volatility regime, something that would be somewhat reminiscent of 2018. If you recall, overall, it was sort of a neutral year, but it had a lot more volatility from an intermediate term perspective.
I want to get to small caps, Katie, because a lot of people were all excited with the recent run up. Basically, at this point, we've given up the gains that we made, for the entire fall when people started getting really bullish on it. What are you seeing here for small caps? Is it over?
It's too early to say that too, but we do have today a DeMark signal. If you know the DeMark indicators, it's the first buy signal that we've had in this pullback mode. And that's kind of interesting to us for the Russell 2000 index as it comes into support from September. It's also right around some support based on some other measures that we use. So it does have a good chance of holding up here based on that. We'd, of course, like to see that stabilization for more confidence that the short-term low is put in place. But interestingly, if you look at IWM as representative of the Russell 2000 versus the spiders or SPY, there are signs of downside exhaustion there too, based on the DeMark indicators. And there was a very timely sell signal based on the same model back in March. So we find that really compelling, especially at a time when you tend to get some small cap outperformance associated with tax loss selling or the so-called January effect. Of course, outperformance doesn't always mean that you're getting or relative performance doesn't mean you're getting those absolute gains at all times, but it does suggest that we'll get at least a rebound in here.
All right. And I do want to ask you about banks as well. A bad day Friday, a relatively bad day yesterday, considering the market bounce overall. Financials really underperformed. And again, bad today, Katie. So what does the chart look like?
We're not seeing a lot of breakdowns in the financial sector as of yet, at least not confirmed ones. We always like to see more than a day or two below a certain level, and that would then confirm. So that's what we're kind of watching and waiting for. 10-year Treasury yields, of course, are going to be something to watch there as well. We highlighted in a morning note that they're below some minor support, around 1.46%. And if we do see consecutive closes below that level, that would increase downside to about 1.35%. And of course, that would have an impact negatively on some of those financials, especially the banks.
All right. Katie, great to speak with you. Thank you.
Shepard Smith here. Thanks for watching CNBC on YouTube.